Hi students, so welcome back to class number 20 on this CMA and financial management. So we are in budgeting and budgetary control. So we have covered the major marginal costing unit, and we have started budgeting and budgetary control in our last class, which is class number 19. Please see all the videos in order so that we are covering exactly as per how our study materials are going. Maximum problems we are covering. I don't think anybody will cover this much of volume of problem. I just want to make as much as possible for the students. So today is the second session for the budgeting and budgetary control. In our last class we have seen about most of the explanation of how this budget will be practically. So practical explanation I have given you in class number 19. Please watch that, and with that you can also share your queries what you have. Most of the thing are in practical in nature. If you go through that 19 video, you can also put budgeting and budgetary control in your resume also. So I have given as much as explanation as possible practically, and I will also solve if any more queries you have in the comment section. Please put your comments. So mostly in last class we saw very simple problem, and that is related to raw material purchase budgeting, raw material consumption. So how the budgets will be for that, with a very simple formula. Raw material consumption is nothing but opening stock plus what are the new additions or purchases minus closing stock is going to be the consumption. So with this very simple formula we did the raw material purchasing budget. So today we will see a little bit of complicated problems which we are moving to the next stage of the unit. Okay, so the first problem for the day, the following details apply to an annual budget for a manufacturing company. So annual budget, but it is given in quarters. So 4 quarters make the annual budget. So this is the complete budget document. So what they say is, this is the input. As a finance department, you will get inputs from various departments. So now for the manufacturing company, you have got these details. So what are these details? Working days in each quarter. So the manufacturing head has to approve this, and then only it has to reach the finance department. So it is the working days. This instruction will go to the labor, and labor will plan all their holidays accordingly. So this is for the next year. This will be fixed for any manufacturing company. For next 1 year, what will be the working days and what will be the holidays? That list would have been circulated. Production units per working day. So guys, this is production, not the production quantity. It's a production per working day in that quarter. Raw material purchases by weight on the percentage by weight of annual total. This is the raw material purchases. They have not given the purchase quantity in kg. They have not given the purchase in rupees also. They have given purchases in percentage. So for example, 100% is the total purchases in a year. 30% is bought in the first quarter itself, 50% is bought in the second quarter, and remaining 20% is bought in the third quarter. And fourth quarter is mainly the consumption is taking place, no purchases is this is the purchase schedule. This is also vetted by the inventory controller of the company so that the optimum inventory will be maintained. Next is the budgeted purchase price. So purchase price, how that will fluctuate. So the raw material purchase per kg, it is 1 rupee in the first quarter, and it is 1.05 rupees in the second quarter, and 1.125 rupees in third quarter. So the our management and the purchase department, they are forecasting the prices of the raw material will go up. That's why they are making the bulk order. Okay, 30% of the raw material they have got for the year. 30% requirement they have got in the first quarter itself. 50 percentage, since there is a price uphill movement, 50% they could have bought all the 100% in the first quarter. It will unnecessarily be an inventory lying in a company. And also we don't know how the sales will really unfold. If some unfortunate situation like Russia Ukraine crisis which is going on now, something take place, our sales will drastically fall. So we have to schedule. So from the risk proofing and also our money, in order not to lock in the inventory, we are ordering only 30 percentage, and price will go up, and next quarter we will put the 50 percentage order. We are safeguarding as much as possible. and in the next quarter put the remaining so that our whole year is saved. Okay, so that is the ideology. So when we see the numbers given in the question, we have to form a ideology, and we have, so that while answering your question in the examination, it will become easy, your flow will be very fast. Quantity of raw material per unit of production is 2 kg. So we know number of working days in a year or in a quarter, and number of units that is made in each day, we know that, and each unit of production, how much kg of raw material is required, 2 kg for every unit, that also we know. Budgeted closing stock for the raw material is 2000 kg is the budgeted closing stock of raw material. So it is a common raw material going to all, common raw material, and raw materials closing stock is given. The raw material closing stock is 2000 kg. Budgeted opening stock for raw material is 4000 kg. So the beginning of the first quarter, the opening stock is 4000 kg, and closing stock at the year end, which is at the end of the fourth quarter, which is 2000 kg. So we are starting with 4000 kg, we are ending with 2000 kg. Okay. Issues are priced on first in first out basis. Calculate the following budgeted figures. Quarterly and annual purchase of raw material by weight and value. So here it is very important. Quarterly and annual purchase of raw material. So we need to know the raw material purchases by weight and value. Okay. So we have to find that quarterly, and if we add all the quarter, it's going to be annually. So that's not a problem. So in our last class, we saw this formula, and I have put the formula here also. Raw material purchase, what is the formula? Closing stock plus consumption plus raw material consumption. You can also say it as from your stores, how much you have issued raw material to the production. Okay, to the manufacturing line, the materials will be moved. That also you can say it as consumption minus opening stock is going to give you the RM purchases. So what is raw material purchases? Closing stock plus consumption. How much raw material you have consumed for the production minus opening stock is RM purchases. You can say this formula little more easy also. What is RM consumption? Consumption, what you have consumed, is nothing but what is the opening stock, and you have added the purchases to it, and minus what is the closing stock that is left out, that is going to be the consumption. So this is the rearrangement of that, because we are going to find the purchases. And second question is closing quarterly stock by weight and value. We have to find the closing stock. So that is the second question. Let us answer the first question. So working days is given in each quarter, and production per day is given. So if we multiply the first two rows, we will get the total production in the respective quarter. And we are also given a data that raw material for 1 unit of production is 2 kg. So the total production quantity into 2 is going to be the raw material requirement. Now we have in kg wise what is the quarterly requirement. So here we have found only the requirement, but what we have to find, the purchases required. We have to find the purchases required. So we can add all this quarterly requirements, which comes to a total annual requirement of 52,000 kg. This is RM required, or nothing but RM consumption. So this is the consumption we have got here, which is 52,000 rupees annually. And closing stock, it is given in the question as 2000. So add closing stock to the consumption. So 2000 is added to it, and reduce the opening stock minus opening stock, which is 4000 in kg and 4000 in cost also. So now we are doing everything in the kg. So less opening stock in kg of 4000. So the annual purchase is 50,000 kgs. We know one thing, that quarterly and annual purchase of raw material is the question. Okay, so annual purchase by weight we have found, which is 50,000, and now we have to split this into quarterly purchases. For that, very important input is given. The person by weight, they have given the percentage 30, 50 and 20. So 30, 50 and 20 is the allocation for the first, second and third quarter. So you can apply on this 50,000 kg, and you can find how much is the quarterly purchases. So we have found the quarterly purchases in kg, Annual purchases in kg we have found. Now we have to value it. How to value it? So these are all purchases. If it is consumption, there is first in first out mechanism we have to apply. uh, which value goods you have issued to the production, that value you have to apply. Okay, but here it is purchases. So purchasing price, it is already given 1 rupee, 1.05 and 1.125. So we are just applying the purchasing price. So kg multiplied by the purchase price, you can find the annual purchases in rupees. Now we have found in the rupees. Now you can add all these purchases in rupees to find the annual purchases in rupees. So annual purchases in rupees we have found, annual purchasing quantity we have found, quarterly purchasing quantity we have found, and quarterly purchases value in rupees also we have found. So this is the, so what we have to keep in mind is, what is the twist here? The twist here is we have applied the formula and found the total RM required for the year and also the total RM purchases for the year. But here they have asked quarterly also. That is the twist in this question. So till 50,000, I see many students do it rightly and they also understand it very clearly from the study material itself. But in the allocation point of view, there are a lot of issues. So we have to allocate the purchases and then apply the purchase price to find the value. So budget should have the quantity also the value. So here they have given the purchase price. So we have to find both of them. Yes. So the second question is closing stock. Okay. So for closing quarterly stock by weight and value. So weight we can find, but value also we have to apply. This is the closing stock valuation. This is nothing but inventory valuation. If you are in a manufacturing company, you would already know. So this is, they have also said it is first in first out mechanism, because the purchase price is not constant over the year. It is changing 1 rupee, 1.05 rupee, 1.125 rupee. So whatever is the stock left out, how much stock is left out? 1 rupee stock is left out. How much 1.05 stock is left out? How much 1.125 stock is left out? So this is little bit complicated calculation when it comes to a large data. But here we are going to simply understand the concept. For which, for closing stock, what all you need? You need to know the consumption, you need to know the opening stock, and you need to know the purchases. Quarterly purchases, yes, we have calculated here already. 15,000, 26,000, 11,000 quarterly purchases we have already calculated. And quarterly, what is the requirement? That also we know. Quarterly RM requirement 13,000, 13,200. Requirement is nothing but the consumption. So we know the consumption data also from here, and also we know the purchases data. So remember these two figures. So consumption is like 13,000, 13,000. And also the purchases is like 15,000, 26,000. Now we are going to calculate the closing stock of every quarter. Let's move to the next slide. So let's first find the opening stock. So opening stock is given as 4,000 kg. So opening stock is in kg, is 4,000 kg, and I am adding the purchases to it. What is purchases? We saw it as 15,000. So I am filling all the quarter purchases. In our previous slide, we saw 15,000 is the first quarter purchase, 25,000, 10,000. This is what we have calculated in our last, in the first question. And add, I'm adding the opening stock plus purchases minus raw material consumption or raw material requirement is going to give me the closing stock. So what is the, so I am adding it and reducing the RM consumption. This also we calculated in our first question. In our last slide, which is 13,000, 13,000, we are reducing this consumption. So when we reduce this consumption, we are landing up at closing stock. Okay, just fill for the first quarter alone, we are doing the calculation. For the other quarters, we have to just fill the data, because we still don't have the opening stock of other quarters. Only for opening stock of quarter one we have the data. Okay, so we found the closing stock in kg. So how to value the closing stock in kg? We are already left out, we are having 4,000 kg of opening stock. How much you are going to consume in quarter one? It is 13,000 kg. So 4,000 from the opening stock itself it can be consumed, and it is already said that 4,000 kg is 4,000 rupees. So per kg 1 rupee, and 30% we are buying purchases. So how much is the purchases? 15,000 kg we are purchasing in quarter 1. In quarter 1 we are purchasing 15,000 kg. We are already having 4,000 kg as opening stock. So in the first quarter we have 19,000 kg of raw material and only 13,000 we are going to consume. So we are in the process of calculating the closing stock. One easy thing is opening stock is also in 1 rupee per kg and purchases what we have done, that is also in 1 rupee per kg. So first quarter purchase price is 1 rupee per kg. So whatever is the purchases we have made, 15,000 kg of purchases also 1 rupee in kg. So there is no confusion and the closing stock will also be in 1 rupee per kg only. So because the consumption is lesser than opening stock plus purchases. Okay. So everything, so 6,000 quantity is the closing stock. We know the closing stock, opening stock plus purchases minus consumption is going to be the closing stock. So closing stock, everything is 1 rupee per kg. So 6,000 kg multiplied by 1 rupee is going to be 6,000 rupees. So closing stock we have calculated for the quarter 1. Quarter 1 closing stock is going to be the opening stock for the quarter 2. So 6,000 is taken here. This is 6,000 is taken here. That is the opening stock for the quarter 2. And we know what is the purchases. So adding the purchases, reducing the consumption, you will land up at the closing stock. Now we have the important duty here. If you can see opening stock is 6,000, purchases is 25,000. If you total it, it is 31,000. So 31,000 stock we have and consumption is only 13,200. So 13,200 only is the consumption. So which means the 6,000 quantity is consumed and after 6,000 quantity, okay, so what will be the closing stock? So closing stock that is left out is opening stock plus purchases minus consumption. So consumption is only 13,200 because we are putting very bulk order, 50% of order for the year we are putting in this. So we will have very high amount of closing stock in this quarter. And do we have any previous quarter stock? Because quarter 1 price is 1 rupee and quarter 2 whatever you have bought is valued at 1.05 rupees. So here closing stock is 17,800. Out of this 17,800, 13,200. Okay, so important thing, the closing stock that is coming from quarter 1 will be the opening stock in the quarter 2. So 6,000 kg is going to be the opening stock. So 6,000 kg is the opening stock and everything is valued at 1 rupee. So that's why the cost is 6,000 rupees. So 6,000 kg, okay, and you are going to consume 13,200 kg and it is first in first out mechanism. So which means the quarter 1 order will be consumed first and then only the quarter 2 purchases will be used. So all this 6,000 will be consumed in this 13,200 and all the stock that is left out will be the items which are purchased in quarter 2 itself. So 17,800 is the closing stock and the 17,800 is valued at 1.05 and 17,800 kg multiplied by 1.05 rupees is 18,690 is the value of the closing stock. Now what we are doing, 17,800 kg is the closing stock. I am taking the closing stock which will be the opening stock of the quarter 3. Now how much I am purchasing? 10,000 we have calculated in our previous slide itself. And reducing the consumption, 13,200 is the consumption we have reduced and closing stock is 14,600. In this 14,600 we have purchased 10,000 is a new purchase. So 10,000 is left out because first in first out mechanism we have to consume first the purchases we have made in the quarter 2. Then only we have to touch the boxes of what we have bought in the quarter 3. So 10,000 is bought in the Q3 and out of 14,600 remaining 4,600 is the quarter 2 stock which is carry forward to the quarter 3. So 4,600 is quarter 2 which means it is bought at 1.05 rupees and 10,000 is bought at 1.125 rupee. So 10,000 into 1.125 plus 4,600 into 1.05 is the valuation of the closing stock. So closing stock valuation for quarter 3 we have done, and 14,600 is the closing stock in kg, which will be the opening stock for the quarter 4. We have not done any purchases, but we have done some consumption, and we are left out with the closing stock at 2000 kg. So all this 2000 kg left out is all bought in the quarter 3 only at a price of 1.125 rupee. So 2000 into 1.125 will be the closing stock valuation for quarter 4. So students, so what we have to do is the opening stock figure alone you can leave blank in your table, and for the first quarter you can do the calculation, find the opening stock by kg, and that kg of closing stock for the quarter 1 will be the opening stock for the quarter 2. Same way, closing stock in kg for the quarter 2 will be the opening stock in kg for the quarter 3. So do same math and calculation. The main where the student goes wrong is here, how to value the closing stock. Quarter 1, quarter 2 and quarter 4 there is no issue. In quarter 3 there is a confusion. We should not get confused. First in first out mechanism, stock bought in quarter 2 will be consumed first, and then only the quarter 3 boxes will be opened. Okay, that is called first in first out mechanism. So students, we will go to our next problem. Okay, so this is a very simple problem. I have not solved it, but where the students will have a query, I have plotted that alone. Okay, we are preparing a selling and overhead budget for which advertisement expense value is given, salary of sales department is given, expenses, fixed expenses is given, salesman's remuneration is given. So all these are expenses. Okay, so you can directly take to the budget that these are all the budgeted expenditures. So one thing where the confusion is salesman's dearness allowance. So salesman's dearness allowance is commission at 1% on sales affected. So what is sales affected? Okay, salesman is a person who is selling our product. But when the customer directly comes to us and they are buying from us itself, then the salesman's sales is affected. Okay, when I'm a seller, I'm having a salesman, I'm selling on my own also, and I am selling through my salesman also. Whenever I am selling, which means indirectly I'm affecting the sales of the salesman. If I am not selling, of course the customers are going to buy only from the salesman. But if I am also selling, the customer has an option. Let us walk into the original showroom itself instead of the dealer. If the customer goes like this, so dealer's sales will be affected, all the salesman's sales will be affected. For whatever it is affected, that much we are compensating the salesman. Here 1% on sales affected is the compensation given to the salesman. This cost has to be calculated correctly, because most of the students I have seen 1% of sales. So here they have given various cases. So 80,000 is a sales during the day, 80,000 is a sales. They have applied 1% on sales. No, 1% on the sales that is affected to the salesman. So 80,000 including agent's sales is 8,000. So which means 8,000 agent has sold. There is no issue. So 80,000 is a total sales for our company. So 80,000 minus 8,000 is 72,000 is our original sales. What we have made on that 72,000, salesman has missed the opportunity, or salesman got affected. So 1% of 72,000. In the second case, 90,000 minus 10,000, 80,000. 1% of 80,000 is the commission. So we have to calculate the commission correctly, then only the budget figures will be right. Carriage outwards 5% on sales, that is easy. 7%, 7.5% on sales, that is also easy. So you can just tabulate all those costs. So you know what is the sales, you know what is the cost. So you can accumulate everything on a table and you can present the sales, selling and overhead budget. This is a very simple problem, guys. I know you can do it. Let me move to the next problem. Okay, so till now we have seen many problems related to material, raw material purchases, raw material utilization budget, production quantity budget. So something like that. Okay, with a very key formula, RM consumption or RM required is equal to opening stock plus purchases minus closing stock. This is the mantra, or this is the formula continuously we were applying. But now this is a different problem. Okay, we have to do the cash budget. So ABC Limited, a new started company, wishes to prepare cash budget from January. So month on month cash budget we have to make. Prepare a cash budget for the first 6 months following estimates of revenue and expenses are given. Now various department will give you all the inputs, all those are consolidated, and within the finance department you have to do the cash budget. Cash budget is very important because our cash position should not go very below the minimum cash metrics that our policies are keeping. Then at times some payments, very important payments will come, we may miss the payments and it will go to any legal complications. So the company may also go bankrupt when they are unable to pay their debt. Okay, if they cannot pay the interest on their debt, they can go bankrupt. So if they cannot pay dividend to the investor, if they cannot pay to the creditors, if they cannot repay the bank loan, okay, so for all these things we have to keep the cushion. So there will be a minimum cash balance that is set up by the company. Anything that goes below will have a very high level of management will see this metrics, cash metrics. Okay, now we have got all those estimates. What are all the estimates for every month, January to June? 6 months data is given here. What is the sales that has taken place? So sales means revenue, money will come in. Materials cost is money will go out for the purchasing raw material. Wages we have to pay for our employees, and overheads for the production we have to pay for the various vendors, and selling and distribution also we have to pay for various service providers. So only the sales is the inflow, remaining all the things is outflow. But it's not as simple as that. It will be a very tedious scheduling of activity that will take place. Okay, so first most important data that has come in with the cash balance on 1st January. So January to June is the period for which we are going to work. For January opening, we have 10,000 rupees in the bank account. Okay, so I am putting 10,000 rupees is the opening cash balance for the January. Next, a new machinery is to be installed. So based on the production manager's approval, it has come to finance department. They have to buy and install a new machinery. The cost of it is 20,000 rupees on credit. So what is credit? We need not pay immediately. We can pay it on the later stage. Okay. To be repaid two equal installments of 10,000, 10,000. To 20 rupees is the cost. We are going to repay in two equal installments in March and April. So payment to new machinery in March and April, 10,000, 10,000. I am putting a negative sign for it because whatever we have to pay out, I am going to put in negative. Okay. Next, what we sales commission of 5% on sales is to be paid within a month following the actual sales. So whatever is the sales that has taken place in the next month, 5% sales commission has to be paid. So sales commission, so we have 1 month credit period for it. So for January it is 20,000. So 20,000 multiplied by 5% is nothing but 1,000 rupees. But the 1,000 rupees is a cost. Sales commission is paying outside, so it is a cost, and that is for the will come in the February only. It will hit our it will hit our cash. The real payout will happen in the next month only. Okay, so for the January, 20,000 is the sales, 5% is the commission, which is 1,000 rupees. So 1,000 rupees is effectively paid out from the cash balance only in the February. So same way for February we will pay in the March. For the March we will pay in the April. So you can put this all the schedule of the all the payment of sales commission you can put on the month on month. So you can create the table and month on month, with 1 month delay you can put the sales commission. Next is 10,000 being the amount of second call may be received in March. So what is second call? We would have listed, we would have given our shares to the investor, and for the value money we have got, that is the share money, and we would have not got all the money in one tranche. Sir, for example, the equity share of 10 rupees each, we have sold it for 200 rupees. We would have got the first call 100 rupees and second call as 50 rupees, third call as 50 rupees. So 200 rupees is the sales what we have done. So this is the second call money that we have received for our equity shares which we have issued to the equity shareholder. So this call money what they have given 10,000 received in March. So in March month we are receiving this 10,000. So I am putting in positive sign because this is the cash that is coming in. Our cash balance is going to go up. Okay, share premium amounting to 2,000 is also obtained. So share premium is the premium, the how much higher than the real book value we are selling. So that is the premium amount. So that premium amount 2000 is also received along with the call money. So 2000 is also we have received. So I am putting 2000 also in the March month. So March month call money and share premium we have received. Next, whatever is the other data that is given, period of credit allowed to suppliers. So supplier of raw material, 2 months credit period is allowed. So if we give, if the raw material for January we have received, we have to pay for this 20,000 only in the March. So 2 months credit period we have. So in the February 14,000 materials we have received, but March, April only we have to pay. Okay, 2 months of credit period we have. The actual cash outflow will happen only after 2 months for the raw material. Period of credit allowed to customers. So customers means we are selling the item and we are not getting the immediate payment from the customer. We are giving 1 month credit period to the customer. We are giving 1 month credit period to the customer. Okay, so delay in the payment of overhead. So for all the overheads, they have not given the classification. So for production and selling and distribution overhead, so all the overhead 1 month credit period we have. So what is the actual expenditure? So for January month the payment will happen in February. For February month payment will happen in March. This is the most important. So as and when the expenses happening, or the activity is happening, that does not mean the cash has taken out. Cash would have been in the next or next to next month. So cash budgeting is very important. So we would have postponed all the payment in 1 month. All the payment will be affected out and the cash balance will become lower than minimum, and some loan repayment will come and we will not repay. So everything is a schedule of activity has to be taken place according to the budget, at least very similar to the budget, and any deviation with the management approval we can do for any critical thing. But this is what is the importance of cash budget. Suddenly we may postpone the payment, this 1,000 rupees, okay, we can pay in the next month, we will pay in the next month, and that month we will have a very good cash balance. But next month all the payments will be accumulated and cash balance will go drastically adverse. Okay, now we are scheduling all the activity. So till now we have not okay, wages we have seen, delay in the payment of wages by half month. Okay, half month. So which means for January month, for 30 days only 15 days of payment will take place. So we are postponing by half month. And for the remaining half so first half of the January month will be paid in the January, second half of the January month will be paid in the February, and first half of the February month will be paid in the February itself, second half of the February will be paid in the March. So every month we will book only the uh, first half of that month will be the cash payment, and also the second half of the previous month. So 15 days, 15 days it is good. This is a very challenging input. How we are going to affect in our cash budget, we have to see that. And last data is assume cash sales is 50% of total sales. So which means we are doing the sales, and out of the sales data is already given. 50% of the sales is cash sales, which means we are giving the product and immediately receiving the payment either in the cash. So that is immediate settlement we are getting in the cash. So which means that has to be booked on the same month itself. So 20,000 is the sales. If you can see here, cash sales is 50%, so 10,000 on the same month. I am putting in the positive sign because it is the receipt what we have got. So February month 22,000 is the sales, 50% 11,000 on the same month. So March month 28,000 is the sales, so 50% 14,000 is the cash sales. So remaining or credit sales. So remaining sales or credit sales means 1 month credit period they have given. So 1 month customer can pay it in the next month. They can buy the item in the next month they have to pay. So remaining 50%. So we are just postponing the same. If you see this cash sales 10,000. So what is the credit sales? That is also 10,000. When we will get for January sold item, we will get only in the February. So 10,000 I am taking in February. This is the credit sales. So credit sales of 10,000 is gone to February, and 11,000 is a cash sales for February. How much will be the credit sales? That is also 11,000 because 50% division. So 50,000 credit sales we will get the money only in the March. So I'm just postponing. Okay, for the June month. Okay, for the June month 40,000 is the sales, cash sales 20,000 rupees we will get in the same month, and May month whatever is the sales 15,000 we will get in the June. Okay, the remaining it will happen, which means the June credit sales. June credit sales, whatever has happened, we will get in July only. But cash budget we are making only till June. Okay, don't go for making the July month. Okay, so for the we have put the whatever the credit sales 1 month delay, and whatever the cash sales on the same month we will recognize it in the cash budget. Yes. Okay, so sales we have booked until now. All the items we are plotting in the cash budget. Okay. Next is the supplier payment. It is given for all the raw material purchases. The payment will happen 2 months later. Okay. So for example, 20,000 rupees materials you have got in January, but actually you will pay for it 2 months later, February and March. Okay, March month only you will pay. So supplier payment I have put in negative sign because it is cash that is going out. So 20,000 in March. Okay, 14,000 bought for February, so 14,000 in April. So with 2 months delay you can plot it down. And wages, here it is a very important thing because half month delay. Okay, so 4,000 is the wages for the January month, but actually with 15 days delay we will pay out only 2,000. 2,000 is the first half of January will be paid in the January itself. Second half of the January and first half of the February will be paid in the February. Second half of the February and first half of the March will be paid in the March. So same way, second half of January is 2,000 rupees. First half of February is 4,400 divided by 2, which is 2,200. So 2,000 plus 2,200, 4,200 rupees will be paid in the February. Okay, so 2,200 for February is still pending, and 2,300, which is 4,600 divided by 2, which is 2,300 is the first half of March. So half of the March 2,300, half of the February 2,200, putting together 4,500 will be paid in the March. So friends, give a lot of importance to this wages calculation. This small input, wages half month delay, this is very important, and answer will go wrong because of this. So wages is very important. So give importance to this wages. We are delaying it by 15 days. If 1 month delay, 2 month delay, that is easy. We can give the effect of it to the cash budget easily. But half month delay, there will be little calculation mistake, because during examination you will have little bit of tension of answering the question within the time. So in that tension you may go wrong in plotting the wages cash outflow for the wages. So be very careful. But most of the time when nothing is mentioned, every month salary will be paid at the month end. So every month in the last working day the salary will be paid. So wages can be booked on the same month itself. But here they have kept a twist, half month delay. They are going to pay out with half month delay. That is why the problem is. Okay, next the production overheads, they have given 1 month credit period for the overheads. So delay all the outflow by 1 month. So January requirement is 3,200. Selling and distribution 800. So January will be paid in the February. So 3,200, 800. So everything I have postponed by 1 month. Okay, that is done. Now we can add all those what we have plotted, and for January month we can find the closing balance in our bank account will be 18,000 rupees, which will be the opening balance for February. So for all the month we should not open. I have seen many students who have forget to plot this opening stock itself. Now only for January we have to find the closing stock, which will be the closing balance, which will be the opening balance for the February 18,000 rupees. So I am taking the 18,000 rupees here, and we have plotted all those transactions that is going to take place in the February. If you add with the opening balance, 29,800 will be the cash balance for the February, which is going to be the opening balance for the March. Now all those, so March is going to have tedious transactions because that is the year end. So there will be a lot of transactions. Yes, we are plotting all the transactions, we are adding all the transactions. So be very careful in plotting this negative sign and positive sign. Payments, all the payment will be in negative sign, all the receipt will be in the positive sign, and this sign mismatch also will go on drastically changing your, because if 1 month you have done the mistake, closing balance will be mistake, and the mistake will be carried forward for all the month. So be very careful. The closing balance for the March is 27,000 closing bank balance, and that will be the opening bank balance for the next financial year, which is April, and all those transaction has taken place. So give effect to all those transactions. So payment to machinery is outflow, it will be negative. Sales commission, yes, we are paying to the outsiders or dealers, that will be a outflow. Call money received, that is a receipt. Share premium received, that is also a receipt. Sales, yes, we will receive the sales revenue. For supplier payment for raw material is a payment. Okay, wages paying to the employees, that is also a payment, negative sign. Production overheads, yes, we are going to pay to the vendors. Selling and distribution overheads, we are going to pay to the vendors, negative sign, negative sign. So all the positive and negative sign you can add and find the closing bank balance, and that will be the opening bank balance for the next month. Okay, so apply this, you can find the total cash budget. So my aim here is to make you understand the problem in the study material. Whatever is the representation you have, the same type of presentation you can make in the examination. You can put all the receipts in rows, and then you can add total receipts, and you can put all the expenditures, and you can put total expenditure. Receipt minus expenditure will be the closing balance, something like that also you can present. So I just want to go travel along with the question. That's why I put all the data which is there in the question. And also students, illustration 6 is very similar to this. Please answer it, try to answer it yourself, and whatever is a doubt, please drop that in the comment section. Thank you and all the very best.